Welcome to the Financial Pathway Podcast. We're here to help you go to the next level in your finances with practical advice from speaker and financial planner Nate Skelly.
So today we're talking about how to evaluate a stock, 4 metrics that every investor should understand. And I just want to be very clear at the start of this. I'm not saying that you should just take these 4 things and then start going wild trading stocks based on 4 pieces of information. Really, investing in individual stocks, it contains quite a bit of risk. And in fact, as a financial planner, as an investment manager, I actually don't make individual stock recommendations to clients because picking individual stocks successfully and consistently, that's really the key word here, consistently, it's very difficult. Way more difficult than I think people realize. Very few people actually outperform the market on a long-term consistent basis by picking stocks. So unfortunately, there is this massive ecosystem that's built around evaluating and trading stocks. And the regular everyday people are constantly bombarded with this perception that the way to make money in the market is to be a stock expert and to have to know how to evaluate individual stocks. And this is reinforced in every finance movie, every business channel, all the social media gurus selling their trading courses that promise to make you a millionaire in 8 months. In fact, if you were just to go on Google right now and type in Apple stock price, immediately you will get tons of results for Morningstar and Yahoo Finance and many others that will give you every conceivable piece of information about Apple stock. And it may feel like, I need to know these 100 different formulas and metrics that are displayed all over this page in order to even make sense of Apple stock and whether I should buy it or not. But I really firmly believe that the best way to invest in stocks is via stock funds, mutual funds, and ETFs. Because when you invest in hundreds of companies bundled together, you're not only lowering your overall risk because you're diversified, but you're also increasing your likelihood of a better overall return because, again, trying to pick individual stocks can be akin to finding a needle in the haystack. And even those that do well with it, a lot of times it's not because of skill, it's because of luck. So that doesn't mean you shouldn't be familiar with the basics of stock investing. That's why I wanted to do this episode, not to teach you, hey, if you just know these 4 things, you can pick stocks successfully. But every investor should understand the basics of what is involved with stocks and what these metrics mean. So I'm going to start here, number 1, with the PE ratio. PE ratio, or price to earnings ratio, is what that stands for. It's just a very simple way to measure how expensive or cheap a stock is relative to its profits. There are many similar metrics like price to book, price to sales, price to earnings growth, CAPE ratio. They are all essentially trying to do the same thing, though, and that is get a sense of whether the listed price of a stock is good value. Is it overpriced? Is it underpriced? Or is it fairly priced? And PE ratio is definitely the most common, the most widely used metric. So that's why I wanted to highlight that one today. Here's how it works. So imagine you are buying a business. Before you buy, you would want to know at least 2 things. First of all, how much does it cost? And that would be the price of the stock. And how much money does this company make, its earnings or its profit? And what the PE ratio is doing is it's telling you how many dollars you're paying for every $1 the company earns in profit. So for example, a stock has a PE ratio of 20. That means you are paying $20 for every $1 of that company's yearly earnings. So a lower PE like 10 or 5 could mean that the stock is very cheap relative to its earnings. You don't have to pay that many years worth of earnings in order to own this company. But a higher PE like 50 or 100 might mean the stock is pretty expensive relative to its earnings. And that means the investors expect the company to grow a lot in the future. So a good way to think of the PE ratio is asking yourself, how many years will it take for the company's profits to pay back what I spent on this company, at least at its current rate? So let's just use the classic example of the lemonade stand, just for simplicity. You have a friend who has a lemonade stand for sale. She tells you 2 things. First of all, she made $100 in profit last year selling lemonade. and she wants to sell you the lemonade stand for $500. If we want to put this in terms of a PE ratio, the price is 500, the earnings are 100, at least from last year. So the PE ratio would be 500 divided by 100. So you're paying 5 times the yearly earnings for the lemonade stand. Take 5 years of profits at that current rate to pay you back for what you paid for it. Now, the PE ratio is not the full story, okay? Just because a company has a low PE ratio doesn't necessarily mean that it's definitely going to be a good buy, or a high PE ratio doesn't mean that it's always bad. It just depends on the company and its potential to grow. And you can't just take 2 companies, 2 stocks at random, and then just put their PE ratio side by side. Like, oh, I'm going to go with the lower PE ratio and think that that's going to be able to tell you the whole story. Because it depends a lot on the company itself and what type of company, what type of industry they're in. So for instance, stable companies that have a very high likelihood of just moderate growth, but probably not like high growth, they tend to have a lower PE ratio. So, for example, utility companies or telecommunications like a Verizon or AT&T, those would be great examples of companies that tend to have low PE ratios, because think about the types of businesses they are. They're stable, probably not going anywhere anytime soon, because they have considerable infrastructure, and it's very difficult for another company to just all of a sudden replace them, or at least quickly. But it would also be difficult for a utility company or for a telecommunications company to experience explosive growth just due to the constraints of their infrastructure and the competition that's out there. So they're more stable, steady, moderate growth. Industries that have like higher PE ratios, those would be ones that are expected to grow quickly in the future. So you see this a lot in like the tech space or biotechnology. And why do those industries have the higher PE ratios? Well, basically what's happening is investors are willing to pay more for these stocks because they expect that the company's earnings will grow rapidly over time. Okay, yes, the earnings are here now, but we think it could be much higher in the future. So like a tech company could develop some type of game-changing product or software, and that's boom, it's going to significantly increase its profits. Also, the earnings are future focused. A lot of these companies in these industries will reinvest their profits into research. They'll innovate into expansion. So the current earnings might be small compared to what, again, they're expected to do in the future. And then, of course, there's just optimism. There's excitement. There's confidence about the future of those industries, especially if it's like AI or biotechnology, where a breakthrough could really lead to massive, massive growth. So, for example, let's take a biotech company that makes pharmaceuticals, maybe for cancer treatment or for weight loss. Let's say their stock price is $100, but they only make $2 of earnings per share. That means their PE ratio is 50. Now, relatively, that's high. Like historically, PE ratios have been around 20, somewhere between 15 to 25, depending on what time frame you're looking at. So 50, comparatively to the stock market, is high. But what it's suggesting is that investors are confident that the company's products will eventually be in big demand, and that's going to lead to larger profits down the road. So that's why the PE ratio is higher, and it can be justifiable to be higher. So high PE ratios equal investor optimism, but it comes with more risks, right? If a company has a high PE ratio, it means it's probably going to be more risky, because if the expected growth doesn't happen, then the stock price could drop significantly. So when you're looking at PE ratio, remember, they give great insight into how investors are currently valuing the company's earnings. It's one of the most important pieces of info about a stock, but you have to make sure that you're giving a side-by-side comparison to other stocks in that same industry in order to get a sense of where that PE ratio falls. Number 2, second metric that's really important to understand is beta. This will probably be the term that you're least familiar with. Not a lot of people could tell you what stock beta is, let alone have even heard of it. What stock beta is a number that measures how much a stock's price moves compared to the overall stock market. So it's a quick way to measure how risky or how volatile a stock is compared to the market average. So here would be a simple way to think about it. Imagine that the stock market is like a car driving 60 miles an hour down the road, just steady 60 miles an hour. And let's say that the market is given a beta of 1. That's the measure of the market. So whatever the market's rate is, whatever the market's volatility, that's a beta of 1. If a stock has a beta of 1, what we're saying is that it moves at the same speed as the market. If the market goes up by 10% or down by 10%, we would expect that stock to also go up or down by 10%. It's matching the market's ups and down swings. But if a stock has a beta of 2, you can think of that more like a sports car. It moves twice as fast as the market. So if the market goes up 10%, that stock would be expected to go up 20%. But on the downside, if the market drops 10%, that stock would be expected to drop 20%. So it accelerates faster, but it also decelerates faster. So it's much more volatile. It's twice as volatile as the overall market. But on the flip side, if a stock has a beta of 0.5, so that would be more like those like nice golf carts we have here in Florida. It's only half as fast as the market. If the market goes up or down by 10%, that stock might only go up or down by 5%. So what the beta is showing you is how volatile that stock is. If it has a higher beta, if it's over 1, it's more volatile. You could have bigger gains when the market's up, but you could have bigger losses when the market's down. So tech startup, technology stocks, those would be examples of companies that usually have higher betas. Lower beta is below 1. They're less volatile. They don't rise or fall usually as much as the market, tend to be safer, but they may not grow as fast. So again, examples would be like utility companies or like consumer staples, Walmart, McDonald's, Coca-Cola. These companies tend to have a beta lower than 1. Another way, if you want to think of it this way, like if you're building a roller coaster, okay, beta is like how steep you and how fast you want to make that coaster. High beta stocks are like the roller coasters at Cedar Point. Big ups and big downs, very exciting ride, but it can definitely make your stomach drop. Low beta stocks are more like the kiddie rides at the fairground, calmer, a lot more predictable. So keep in mind, beta helps you to recognize how crazy of a ride, how volatile that stock might be in the future. Number 3, third metric, dividend yield. Now, a dividend is a portion of a company's profits that it pays out to its shareholders. So it's kind of like a thank you for being part owner of a company. Not every stock pays dividends, but those that do, they will typically pay them out on a quarterly basis. So if you have 1 share of stock A, the company decides to pay a dividend of $2 a year. If you own 1 share, you get 50 cents a quarter, $2 a year. If you own 10 shares, you get $20 a year. So it's in proportion to how many shares of the company that you own. So to go back to our lemonade stand example, if let's say at the end of the year, you made $100 in profit from the lemonade stand. Let's say the owner decides to keep $50 and reinvest it in the business, buy a new sign or a bigger stand, but then takes $50 of that profit and pays it out as a dividend to the investors. Maybe you are an investor in this lemonade stand. So $50 is going out as a dividend to the investors. If you own 50% of the stand, you would be entitled to 50% of the dividend, or $25. So now that we hopefully have a good understanding, okay, what a dividend is exactly, it's part of the profits that are paid out to the shareholders in proportion to how many shares you own of the company. Why would a company do this? Why would they just not keep all that money for themselves? Well, first of all, companies sometimes pay dividends to incentivize and to reward people who have invested with them, because for a lot of investors, that's a very attractive thing, receiving a dividend. But also, if you're a more stable, a more profitable company, you might view it as more beneficial or more beneficial to not have to reinvest all of that money, but rather to pay it out to the investors. So you think about like a company like Johnson & Johnson or Verizon, they're established. They don't need to reinvest all their profits. A growth-oriented company, a smaller startup company, is probably not going to pay a dividend. They're probably going to take all that money and reinvest it into their company so they can continue to expand. So it just depends on the type of business and what their goal is with all of that. But what is dividend yield? So we've talked about what a dividend is, but what is dividend yield? A dividend yield is a way to measure how much money a company pays you in dividends compared to how much you're paying for the price of the stock. So a quick example, you buy a stock for $100, the company pays a dividend of $5 a share every year. What's your dividend yield? It's 5%, because $5 divided by $100, you get 5%. So you're earning, if you want to think of it this way, you're earning 5% on your investment just from the dividends. So even if the stock price didn't move at all that year, it stayed at $100, you would still be making 5% because you are getting a $5 dividend on that share. So the thing to keep in mind here is that the dividend is not set in stone. The company determines what dividend they will pay, if any, and they can also change that at any time. It's at the company's discretion. There are many companies that do have a solid track record of consistently increasing their dividends for many years. They call them dividend aristocrats. But again, this is not something where, if they're paying a dividend, they will always have to pay that dividend out. They could change that amount, decrease it, or take it away completely if they so wanted. So here's what you should understand when it comes to dividend yield. Higher dividend yield equals more cash for you, all right? Company with a 5% dividend yield will pay more per dollar invested than a company with like 2% dividend yield. But another thing to understand is higher dividend yield is not necessarily always better. It can be, but not necessarily. Let me give you an example. You bought that stock for $100. It's paying a $5 dividend. So it's 5% dividend yield. But then the next year, the stock drops dramatically and now it's worth 50%. Well, your dividend yield, though, has actually gone up because it's still, if their company's still paying $5 dividend, it's a 10% dividend yield, right? Because $5 divided by that $50 is 10% now. So on paper, it looks like, oh, wow, this is such a great stock. It's paying a 10% dividend yield. But what you're not seeing, if you're not looking closer into the situation, is that, the reason for that is the stock dropped in half from what it was last year. So be careful, because sometimes the reason that a company has a higher dividend yield is because it's struggling and its stock price has dropped. And then also another thing to keep in mind is that typically it's safer and more stable industries that pay dividends. Like we talked about utilities, consumer staples. They're the ones that tend to pay dividends because they're in a position to not have to reinvest all of their profits back into the company. But the fast growing companies like tech stocks, they tend to not pay dividends because they reinvest profits, but it also makes them a little bit more risky overall. So remember this, your overall return is a combination of the dividend yield plus or minus the price change. So when you're thinking about what your total return will be, you also have to include the dividend if the company pays it. So for example, you bought stock A at $100. It has that $5 dividend. At the end of the year, the price is now $103. Now, if you were just to look at the price, you would say, oh, my investment went up by 3%. But that's not your overall return. Because of that $5 dividend, your overall return was actually 8%. And what a lot of investors do is they will take those dividends and they'll use them for income. But if you're a long-term investor, what you're typically going to do is reinvest that money. So you will take those dividends and you'll buy even more shares of that same company so that even in years when the stock has stayed flat or even fallen, you're still buying more shares, and that leads to a higher overall return over the long term. And then fourth and last metric that I want you to be aware of is market cap. You've probably heard this term being thrown around before. It's short for market capitalization. Really what it tells you is the total value of a company if you add all their shares of stock together. In other words, if we're asking how much is this entire company worth, that's its market cap. And to find a company's market cap, you just simply multiply the number of shares that they have outstanding times the current stock price. So if a company has 1 million shares of stock in the market and each share is worth $70, their market cap is $70 million. A good way to think of it is like a pizza, right? You have your pizza and it's cut into slices. Those are your shares, your individual stocks. You find the price of one slice and then you multiply it times the number of slices in the pizza, and that tells you how much the whole thing is worth. The companies, here's a common misunderstanding. An individual stock's price actually has nothing to do with the overall size of the company. So you say, oh, okay, this stock is $100 a share. This one's $200 a share. Okay, without knowing how many shares there are, that actually really doesn't tell you anything. There's really no reason. Well, I mean, there are some simple reasons, but technically, there's no reason why Apple stock couldn't be $1 a share if they wanted to split into more shares. So let me give you a quick example. One share of Apple stock, as of today when we're recording this, it's worth about $240 a share. But one share of Visa stock is about $310. So does that mean that Visa is a larger company? Well, no. Apple is about 6 times larger than Visa. What's happening is that Apple just has way more shares of stock available than Visa. So to buy one share of Visa, yes, costs more money, but there's not nearly as many shares of Visa. So we have to multiply by the price times the number of shares to see the total size of the company. And when you figure out the market cap, it gives you a sense of how large a company is. And we typically categorize stock market caps into small, mid, and large cap. Small cap is worth less than $2 billion. These would be small, growing companies. Mid cap would be between 2 to 10 billion. These would be companies that are more established, but still growing. And then large cap companies. This is anything over $10 billion. So these are the big, stable companies, your Apple, Visa, ExxonMobil. Most of the brands that you can think of would fit into the large cap company category. So what market cap helps us to do is it's a quick way to see how big a company is compared to others. All right, so that's going to do it for us for today. Thanks for listening to today's episode where we broke down 4 important metrics to help you evaluate a stock like a pro. Remember, understanding things like PE ratio, beta, dividend yield, market cap, it's not just for the financial experts. It's for anyone who wants to be a more informed investor. So I hope you enjoyed today's episode, and please make sure that you're following, subscribe to our YouTube page, share it with someone who's curious about investing. And as always, feel free to reach out if you have questions or topics that you'd like to hear in future episodes. So stay curious, stay informed, and make wise financial choices. And I will look forward to seeing you on the next episode.